Hi, good afternoon, everybody. Should do a sound check quickly. Can anybody just type in a little box, the question box, if you can hear me clearly? I appreciate it before going on. Can you hear me clearly? Great, thank you. Thanks, great. Okay, people, welcome. Welcome to our webinar today, discussing inflation, interest rates, and GDP. My name is Sean van den Berg. I head up client education at PSG Online. Our topic today just happens to be on the day that they actually release CPI figures. So it's nice and coincidental. So we're going to be focusing on obviously inflation and the implications of that for you as an investor, you as a consumer, or obviously implications for the market and things like that. So here's the agenda, very briefly. And like with every other webinar we have, this presentation is being recorded. And those of you that are on this webinar, you will be receiving the PDF version of the PowerPoint presentation as well as the recording. It's for review purposes. It's for you to go through it again. Obviously, any questions you have, you can always email me afterwards. Also, while we're in this webinar, any questions you have, just type in the box, and I'll try to answer it as we go along. If not, I'll answer it at the end of the webinar. Alternatively, I'll send you an email. If I can just give you ask you a favor, just keep the questions nice and short, to the point, just save a lot of time. Okay, so we're going to talk about, the main focus today is obviously inflation. And what is inflation? Why is it important? People don't understand the real implications of inflation. And I'll conclude with the statement that inflation is public enemy number one. And you'll see why just now. Okay, so let's get started. It's about half an hour, nice and short. Let's go quickly recap. Obviously, this follows on from 2 weeks ago when we spoke about the investment cycle. So there will be a bit of overlap here. But just to quickly introduce the subject, it sounds obvious, but most people don't understand that the investment performance or the market is associated with economic activity. There is that relationship. So companies perform well when the economy is doing well and is strong and prosperous. But not all industries or companies prosper equally. Now, that's your goal as an investor, is to assess the impact of that changing economic environment on particular companies. And to put that into a nutshell, we talk about gross domestic product, GDP. It's the broadest measure of economic activity in a country or a nation. So basically, it represents the value of total amount of goods and services being produced, be it in the agriculture industry, or in factory, construction, trade, services industry, you name it. So it's the total amount of goods and services being produced within the economy. So GDP can also be viewed as the total sales index. So the marketplace, the economy, would obviously gauge, is a gauge for measuring that value. So here in South Africa, the way we measure the GDP, we look at South Africa's production, and we'll talk about productivity a bit later. So it includes exports, but it excludes imports. Remember, imports are consumed locally, but they are produced overseas. So we only focus, obviously, on the exports, which is produced here locally. GDP can be used to show how much an economy has grown or contracted during a given period. Now, our economy is not doing too well, and we'll talk about it a bit later. And obviously, we need to stimulate economic growth. But worldwide, there are telltale signs that there are pockets of growth, but we're not shooting out the lights yet. So it's very slow economic growth at this point in time. But this is where I want to focus on today, is inflation. Inflation is prices increasing from year to year. Okay. Alternatively, you can look at it as a decline in purchasing power of your paper currency. Okay, we're talking about some examples just now. Over the long term, inflation is caused by governments increasing the money supply faster than GDP, the growth of GDP. In other words, they're printing money. So remember, what is money at the end of the day? Money is the symbol of goods and services being produced by economy. If the size of the money supply increases by 20%, but the number and value of goods and services remain the same, we'll have this pressure. Prices have to start going up. You have 20% more money chasing the same amount of goods and services. So demand is exceeding supply. There has to be pressure, prices have to start rising. And we'll talk about just now, we'll talk about the lack of pricing power and things like that. But when we talk about inflation, and we talk about CPI and things like that, inflation is measured by measuring prices. The most common measure here in South Africa, what we use is what they call the CPI, Consumer Price Index. It measures the retail prices and expresses that result as the index figure. And obviously, we have an annual percentage increase over that period. We also have month to month. And you'll see the figures that came out just now from Stats South Africa. So from an investment point of view, inflation is a very, very important thing to look at. Because why? It's an indication of future interest rates. Where's interest rates going? So there's a very close relationship between inflation and interest rates. If inflation is on the rise, interest rates will follow. We will see interest rates increasing also. And obviously, the relationship with interest rates in the stock market is like a seesaw. Interest rates go up, the market comes down, and vice versa. So it's very important to watch what's happening with inflation. Alternatively, if inflation decreases, interest rates also come down. So it's imagine like a seesaw, and the relationship with that in the stock market. There are different classes of inflation. The most commonly one uses what they call the inflation index. It's called the headline consumer price inflation. It's a basket of goods that a household would commonly purchase as such. The price of that basket of goods is monitored on a regular basis. So obviously there's certain things in that basket, and certain things have more important weightings. For example, petrol or bread. But from this we can determine the rate and level of price increases over a period of time. Okay. Now it's the rate of change in that CPI over a period of time which is important. Now it just happened this morning at 10 o'clock this morning, Stats South Africa released the headline consumer inflation figures for January. Remember we're talking about inflation targeting just now, but inflation has accelerated to 5.8 year on year from 5.4 in January. Okay, sorry, in December. Okay. What's important about these numbers, if you look at the last line here, economists polled by Reuters had expected a 5.7 and a 0.6 month-on-month increase. So these figures were worse than expected. And you'll see on the next slide how the market reacted. And I was quite amazed how the market reacted. But I think it wasn't so much how the market reacted to CPI. It's more to do with other factors. On a month-to-month basis, obviously, CPI increased by 0.7% compared to 0.3%. So there's been a big jump. Okay, so we saw 2-3 weeks ago, John Marcus, the Reserve Bank governor, increased interest rates because of inflation. So what do you think is going to happen with inflation, with interest rates going forward? We expect more increases. What's going to happen with the stock market? That's obviously will have impact or negative impact on the market. So this is what happened. This is a screenshot of the All-Z, the All-Share Index. This is intraday trading. 10 o'clock was the time of the announcement, and of course the market went up. Now, was it because of the CPI figures? Because we were stumped. Why did the market jump on CPI figures? And I think to a large extent, I think the market had discounted higher inflation, but it's more to do with London Stock Exchange opening. So I think it was just taken in stride. So it was as expected by the market. Obviously, the economists were expecting a bit less, but to a large extent, I think the market were anticipating bad results, bad CPI figures. So that's to the side. Then we also talk about core inflation. This excludes the prices of food, non-alcoholic beverages, petrol and energy and things like that. So this was unchanged year on year, 5.3 and 0.3 on a month-on-month basis for January. Okay, so obviously those basket of things didn't change much. You also have what they call the CPIX. Okay, this is headlining consumer inflation, excluding your mortgage bond rates. This is what the Reserve Bank uses for inflation targeting purposes. And their target is to get inflation between 3 and 6%. Yeah. And also a very important inflation figure to look at is what they call the PPI, producer price inflation. They call this the factory gate prices. It's index of household price changes. And this is viewed as an indicator of future retail price changes. So obviously, costs are going up at the factory, on the factory floor. You can anticipate that those costs being passed on, and ultimately will affect the CPI. Okay. So why is it important to have a low inflation? Remember, the central aim of the Reserve Bank policy is to have low inflation. Low inflation means money will lose value over a slow period of time, if at all, over a period of time. So remember, money serves three functions. It's a form of payment, It's a unit of account for measuring the value of goods and services, but also it's a store of value for savings, for the savers as such. It's also essential that the value of money should remain stable. And I think this is what the Reserve Bank is trying to focus on, in the sense that targeting the rand to make it more stable. And I personally think it's the wrong, the wrong way of looking at it. We'll talk about it just now, and you see some other people have also their opinions. So inflation is a continuous decline in the value of money. Now I use an analogy of, a few years ago you could have gone into ShopRite Checkers with 500 rand, you would have bought, say for example, five bags of groceries. So you go in there 500 rand now, you walk out there maybe 2 bags of groceries. So that's what happens with the value of money. Okay, to buy the same amount of the same goods as you did 20 years ago or 10 years ago, it was going to cost you 2,500 to 3,000 rand. So obviously imagine the impact of that on household expenditure. You have to spend more money on essentials. Okay. So economy cannot function well if the currency is continuously losing value. You can just imagine our rand the whole time. It's falling more than our trading partners and things like that. It's falling out of bed. It's very, very tradable currency, but it's got a lot to do with the fundamentals of the economy. So if inflation is continuously on the decline, obviously that will be a big impact on the value of the money. So price inflation, obviously, the focus is to contain it. You and I, as consumers, want to have faith and confidence in the value of our money that we use. You go on a holiday trip overseas, and you're just scared to spend the money because obviously the exchange rate is so much higher and everything's more expensive. So that's the disadvantage. But saying that, low or zero inflation does not imply that prices of goods and services will not change at all. So there's still a bit of pressure there. So we talk about this price change in response to changes in relative scarcities. And you'll see an example I use now with Billabong. Something becomes less or more available than before. Now, I use the example of Billabong or Quicksilver. Those of you that in the surfing game or know these clothing brands, the Australian brands. Let's say, for example, a fire breaks out in the factory in Billabong. Now, that might result in a smaller supply of Billabong clothing, but also, obviously, a higher price for their clothing in comparison to the competitor, which is Quicksilver. But now, the change in relative scarcity is because of the fire, okay, of the products, not as a result of general price increases, demand, and things like that. Okay. So low inflation means that the continuous rise in the general price level, that means the prices of goods and services drops to such a low level, it no longer influences the decision of consumers or producers. Now, I was watching TV last night, BBC World, and they were talking about Argentina. Argentina is running inflation at 25%. Remember a few years ago, we were talking about Zimbabwe. We're running a few thousand% on inflation. Imagine you as a business owner want to import machinery or something like that. How do you plan? So that's the biggest challenge with high inflation. So obviously low inflation makes it much easier to make decisions. Okay, let's see if there's any questions coming through. Clint, no problem. You're late. You'll get the recording. Okay, great. Okay, it's just some comments on the audio. Thanks. Okay, no questions so much. Okay, so why is it important? What are the preconditions to have an efficient working economy? The producers and the consumers must be able to identify changes in relative prices and goods and services. So the prices are going up not because of price pressures, as we could talk about supply. It's more demand pressures. So there's the two sides of the equation. So identifying those changes in price, in relative price, allows you as a producer or consumer to take appropriate economic decisions. Okay, and obviously you'll be allocating your productive resources, the use of machinery and labor more effectively, but also purchase goods and services more effectively. It's a serious problem when prices are rising continuously. Prices going up and going up and going up. Now I use the example of Zimbabwe again. The guy pushing a wheelbarrow full of Zim dollars to the bank, gets in and the currency is worth nothing because inflation has gone out of control. Throws the paper money away and sells the umbrella, and sells the wheelbarrow to buy a loaf of bread. That's the kind of thing what happens. So You can also take wrong decisions when inflation is very, very high. You can't distinguish properly between changes in relative prices, as I'm talking about scarcity just now, and price increases that form part of the ongoing inflationary process. So it's a challenge. Okay, economic efficiency is sacrificed. That's the bottom line. What happens when inflation is out of control? High inflation rates obviously leads to decline in efficient working of the economy. A lower rate of growth in the economy as a whole is what you want. Okay, sorry, economic growth. At least high inflation leads to lower economic growth, and ultimately, obviously, to lower employment. And we don't want that. You want to have more people employed, and growth, and things like that. So, in the newspapers, once in a while, you might read that high inflation will create jobs. It's not always true. High inflation actually destroys jobs in the long run. So it's true that some policies aimed at lowering inflation might, in the short term, have a negative effect on job creation. And obviously the unions have this thing about eliminating inflation targeting, because in the short term that it does have that impact, but over the long term it does have a benefit. We'll talk about inflation targeting a bit later. Okay, so I've obviously alluded to it already. The disadvantages of especially high inflation. Losses to savers. Your capital value of your savings lose value. Inflation is higher than the interest rates you're receiving. Inflation is running at 5%, but you're only getting 3% on your money. You're going backwards. That's what we're talking about. So the value of your money is being eroded by rising prices, high inflation. And obviously the people that are on fixed pensions, the pensioners and things like that will also be affected. Because the income, every month you get paid your 3,000 Rand, or whatever the case might be. With inflation rising and costs going up, your 3,000 Rand buys you less, and obviously that does affect the pensioners. So there are efforts obviously to hedge against price rises. Okay. The challenge with this now, people rush into precious metals. Gold has been acting like a safe haven, where every time there's inflation fears, we're into gold instead of focusing on production. So resources are obviously wasted, and especially in the situation we talk about hyperinflation, 10,000% per annum. You're talking about Zimbabwe just now, but obviously prices have to be revised frequently, and obviously it's a costly procedure. So the South African Reserve Bank's approach is to lend money to banks at such an interest rate that enables inflation to be brought under control. So obviously when you raise interest rates, you take money out of the economy. So you got to try and keep it, or the Reserve Bank's policy is to try to keep inflation between 3 and 6%. And we'll have some opinions just now from some other brokers, some other economists. Now, this is based on December stuff, December's data, because obviously I didn't, at the time of creating this presentation, I didn't have the latest figures. But in December, inflation, the price of clothing and footwear was estimated to have increased 3.6% for clothing and 3% for footwear in December 2013. The food basket was up by 3%. Okay, so that was the price of clothing and footwear and the food basket. And remember, inflation was 5.4. Okay, so the farmers, the food retailers, and manufacturers cannot increase their prices by 5.4, and that's where we talk about lack of pricing power. So they have a pressure on their sales volumes, and they can't really push those prices through, because remember, the economy is not doing so well. Consumers are under pressure, so they're in a hard situation. And we see some of the retail figures coming through, and obviously their profit margins are under pressure. So rising prices have little or nothing to do with strong demand as registered by consumers. Okay, so it's inflationary fears that can nothing to do with demand, because there's hardly any demand in the economy. Okay, so households are under increasing budget pressures from higher prices and obviously taxes imposed on them. So we're in a very tight spot if you look at the economy and inflation, and especially rising interest rates. If you add a different aspect to it too, they are suffering from a lack of pricing power. Okay, and the biggest thing with that, obviously, everything's going up, and where does it affect you the most? In the labour market. We find that people obviously, you're happy what you're getting. The company gives you 4%, you grab 4%. Not many people are getting price or salary increases exceeding inflation. Some people are getting below that. So obviously the rate of dismissal, and this is figures from AdCorp, in the private sector is accelerating. So workers are not chopping and changing jobs as much as they used to. They're holding on to the jobs instead of just moving on to better paid ones. So obviously this environment is not likely to encourage more growth in consumer spending. So it's a catch-22 situation. So how do we manage the economy? We spoke about this 2 weeks ago. Obviously there's issues, but the monetary authorities, the Reserve Bank, intervenes in the economy. And obviously the focus is obviously on achieving certain goals, like growth and employment and things like that. But if it gets out of control, obviously that's where the government steps into control, to cool down, and that's where we use interest rates. Interest rates as a mechanism to cool the economy down. So we spoke about the inflation targeting. This is information I got from Wikipedia. Inflation targeting is economic policy, for example, a central bank would use to estimate or make public a projected target, inflation target. So the whole idea is obviously transparency, number one, but obviously you're attempting to steer the actual inflation towards that target. You want to keep inflation between 3 and 6% by using interest rates and other monetary tools. Okay. Now, because interest rates and the inflation rate tend to be directly related, there should be some interrelationship. Okay. The banks can either raise or lower interest rates to make it more transparent, obviously to control inflation. But increases in inflation are not necessarily coupled to any factor internal to the country's economy. Now, this is again, my opinion. The two biggest imports we have in South Africa is obviously oil and food inflation. We import in our oil, and we import a lot of maize and things like that. So they can strictly, or as the Wikipedia article says, you can blindly adjust interest rates and will not have really a big impact on inflation. But obviously it'll have a big impact on economic growth. So we can argue about inflation targeting. Does it work? Yes or no? And there's alternatives, interesting things you look at. This is a newspaper article written by Brian Cantor. He's an investment strategist at Investec. He's also the chief economist. This is his opinion regarding monetary policy and inflation targeting. He says monetary policy is doing little to encourage domestic spending. The recent increase in obviously in the interest rates is becoming less so. So it's negative. Even less demand side pressure on spending can be expected as inflation continues to rise. It's driven by the weaker rand, but interest rates will have nothing or no influence on the rand. So I agree with this opinion. I don't think raising interest rates will do anything with the rand. Remember, the rand is like a commodity, supply and demand. It's a very free traded currency. People's perception of the economy, people's perception of the country, be it politically, everything is all reflected in that rand. It's not only inflation. Okay, or when I say inflation, the economy. So a weak economy indicates that interest rates should theoretically be coming down. You want to stimulate growth, interest rates should be going down. Instead of falling, our interest rates are going up. Obviously, we have a deteriorating economy. So inflation targeting, and this is all Brian Cantor's opinion. So inflation targeting, when prices are rising for the supply side rather than the demand side, makes little economic sense. So it was a big surprise when interest rates went up by about 50 basis points 2-3 weeks ago. And obviously, going forward, we can anticipate more. So obviously, with inflation going up this morning, you can anticipate what will the reaction be from the Reserve Bank governor. Okay. So inflation targeting makes little sense. Makes sense when the exchange rate responds to that interest rate increases. But our rand has not behaved like this for the last 12 years. It shows no consistent relationship between the exchange rate and the interest rate. Okay. So this is obviously Brian Cantor, his research. But saying that, aiming for low inflation is a good monetary policy. However, trying to meet inflation targets is proving again to be a poor monetary policy decision here in South Africa. So inflation targeting is fine, but using interest rates as a mechanism to do that is not good. So just quickly summary, inflation is public enemy number one. I hope you guys got a message across. So it's government, industry and consumers overspending. Printing too much money to finance luxuries, byproducts of low interest rates, and that's what we saw in the States. Now, inflation has to start rising. When I was in Durban last night, we were talking about this, and what will be the next cause of the bubble. Obviously, I think it will be the bubble bursting because of inflation, things getting out of control. We've pumped billions or trillions and trillions of dollars into the economy. Those problems have to, inflation has to go up sooner or later, and obviously those birds are coming to come to roost soon. But again, here's a quote from Wikipedia just to conclude. Inflation targeting led by central bankers, most notably Alan Greenspan of the US Federal Reserve, led or ignored or even applauded the unsustainable bubbles in speculative real estate that produced the crisis. In other words, he reacted too slowly as the evidence emerged regarding inflation and things like that. So, maybe our reserve banker is preempting that inflation getting out of control. I believe they should have lowered interest rates much lower. So, anyway, that's my opinion. We're still in the post-crisis. We're talking about the 2008 crisis. Inflation targeting has no longer promoted, obviously, a stable economic growth path. So low inflation has been a drag on economic growth. Now this is where, whoopsie, we go back again, I believe is alternative. Instead of inflation targeting, there's a thing called income targeting. A nominal income target is a policy conducted by the central bank that targets the future level of economic activity in nominal terms. In other words, it's not adjusted for inflation. So this is just another economic buzzword pushed out there. I believe that the only way to get the economy going is to obviously focus on growth, anything to do to encourage growth, to help the business environment. That's what we need. And I think the biggest restraint here in South Africa, I believe, is our labour legislation. So we need to look at that very, very closely. So we've got hard times ahead of us to turn this big boat around. Anyway, guys, that is the topic today. I hope it was insightful. Some information there for you. Here's a question here from Vimpy. Will the news in South Africa today affect international countries and international markets, and how? I don't think economic news in South Africa really affects other countries or other markets as such. Any bad news obviously will be reflected in the rand straight away. That's the fastest way of looking at how international markets view economics here in South Africa. Offhand, I haven't got the information in front of me, but weak inflation obviously is negative, but the rand could have weakened. And ultimately, that's what you don't want. So, Vimpy, I don't know if that's the answer to your question, but it's not so much how our markets affect international markets, it's the other way around. It's just maybe it's people's perception of our market. Okay. So thanks for the question, Vimpy. Okay. Guys, just quickly before concluding, I just want to highlight our upcoming webinars next week. We're going back to technical analysis. We talk about moving averages. What's the difference between a simple moving average, an exponential moving average, a weighted moving average? Which one's the best one to use with the pros and cons? How do you use them? But also want to touch on Bollinger Bands. Very simple tools. I use them all the time. I love moving averages. Very effective. The week after that, we talk about value investing, the Warren Buffett approach to the market. How does he look at investing in a company? The week after that, we talk more about risk management. I talk about the 3 S's, the structure of your portfolio, your diversification or the spread, and then obviously stop loss. And then we come back to technical analysis. We talk about cycle and trend analysis. And then obviously, the end of March, we talk about the income statement. So a bit of fundamentals again, how the income statement structured, and maybe some financial ratios from it. So that's the upcoming webinars the next few weeks, every Wednesday. Yeah, so we'll see how it goes with that. And as I said, I was in Durban last night. Thanks to the guys in Durban for supporting us. In March, I'm back in Pretoria. The topic there will be technical analysis. I'll be talking about the trading methodology that I use, and obviously there are a lot of other methods out there to analyze a company, to make a decision when to buy and sell. But more importantly, obviously when to enter and exit a trade, take profits and things like that. And obviously the training side is risk management. So I'll be at Centurion Country Club. That will be the 11th of March. And then I'm coming down to Cape Town. So if you guys in Cape Town, tell your friends about it, bring you guys along. Remember also, we've changed the format also the Traders Forums now, where we invite you guys to join us afterwards for drinks and snacks. The idea is to socialize, network with other investors and traders, and see what they're doing and how we can help you also. So I'm in Cape Town the 25th of March. Okay. So quickly conclude the inflation. You'll find a lot of information on the online tutorial number 3. As I said, this presentation will be sent out to you guys. Review the PowerPoint presentation, listen to the recording again. Any questions you have, please send it through to me. Please help us or support us with the webinars. Those of you that are on this webinar at the moment, thanks for the support. I see that all regulars come back every week. I really appreciate you guys doing that. And obviously support our Traders Forums. You know, it's 2 hours around the country every month. It's face to face. And yes, it's a bit of information session, but also a bit of training. So it's there for you. There's no cost. So we want to empower you to become better traders, better investors. Those of you that are on the webinar at the moment and are considering joining us, PSG, people so good, profits so great. Okay, consider opening up a trading account with us. Worst case scenario, open up a free trial, test us out for a month, and join us. So last people from my side, good luck and happy trading. Any questions you guys have, there's my email address, there's my phone number. Let me see if there's any questions coming through. Okay. Thanks for the session. Thanks, Philip. William. Hey, William, thank you. That's one of the regulars. There's a question here from Dilip. Why is the US dollar so strong after the Fed continues printing excess dollars? It's a bit of a like I say, the dollar is strong at the moment because of the tapering off of the stimulus. So the market looks at it as we're not pumping any more dollars into our economy because we don't need to stimulate it artificially. The economy is starting to pick up, and that's the thinking behind tapering off the bond purchases. Remember, they were pumping in $85 billion a month into the economy to keep interest rates low, try and stimulate the economy. Now they're tapering it off roughly about $10 billion a month. And I think that just that sentiment is positive, and obviously anything that's positive will make the currency stronger. I hope that answers your question, Dilip. Okay. Okay. Question here from Harry. What if not your computer? Hey, what if you're not at the computer at the stage of a webinar? Well, if you're registered and you're asking this question, you'll be getting the presentation anyway. Anyway, so I don't know if it answers your question. Last question coming through here. Question from Heather. Infrastructure spending could create jobs, but that could be more overspending. How can we create more jobs? Seems high efficiency, productivity, and innovation way to go. That's it. You hit it on the head. Okay. Higher efficiency, more productivity, and obviously innovation. That's it. On the head. That's what we need to do. So again, it comes back to labor legislation. We need to be more growth orientated, more business orientated. So government has to play up to business and help us grow the economy, and that's how we create jobs. At the moment of labor legislation, people are too scared to employ anybody because it's so hard to fire someone. So that's the challenge. Anyway, guys, thanks for the questions. Hope you've enjoyed it. As I say, the presentation will be sent out to you guys. Enjoy the rest of your week. Happy trading. Good luck on the markets, and we'll talk again. All the best. Bye-bye.